Well, hello again to all of Turdville. This is Turd. It is Thursday, the 22nd of January. We're already making our way through January. And this is your latest Access to Access presentation, your opportunity to interact with some of the movers and shakers in the precious metals industry. Today, Nick, you're a mover and a shaker, aren't you? Today's guest is Nick Barisheff. Nick is a renowned author. He's got a great book that we'll discuss here in a minute, but he's also the president and CEO of Bullion Management Group, which is based outside of Toronto. As the name implies, they work with clients to allow them to own gold, silver, platinum, even store gold through a program that they have up there. But Nick, I think, is a great guest to start the year and talk about where we think gold's going to go and with all the current events going on. So, Nick, thank you very much for sort of taking some time and joining us here in Turdville.
Well, it's always my pleasure, Craig.
Hey, Nick, as we get started, tell everybody a little bit about Bullion Management Group and specifically the funds you run, the BMG Bullion Fund. You've got a gold-only fund, and then your bullion bar storage program.
Right. Well, I started with the funds issue, and our first fund is the BMG Bullion Fund, which is a combination of gold, silver, and platinum. So as money comes in, we simply buy gold, silver, and platinum in equal amounts.
Mm-hmm.
We don't market time, hedge, lease, rebalance, any of the above. It's simply we've provided the infrastructure to make it as easy as possible. And since it's an open-end mutual fund trust, it has the same liquidity as the precious metals themselves because we purchase and sell into the markets. So that way you're exactly tracking gold, and you have no gold, silver, and platinum. You don't have any human interference where, you should have hedged that way and you hedge that way and you lose money and so on. So this is as close as you can get to bullion ownership and all the attributes of bullion, but wrapped in a mutual fund because initially the objective was to qualify it for Canadian registered retirement savings plans.
And is it a physical fund, or is it a combination of physical and some futures? Or
only physical. Like we say that in our funds we don't compromise anything. So we have to have interim unallocated accounts in order to buy, because every day money comes in and varies in amounts. It doesn't necessarily match bar sizes, so we're buying ounces in an unallocated accounts and then allocate once we have enough ounces to equal bars, and then it's moved into allocated insured storage.
Got it. And
so it's the vast bulk of it, more than 95%, is fully allocated. We maintain on our website the list of bars, and people can look everything up and see what's what.
And as you said, Nick, it's primarily for Canadian, or at least the main group of owners are Canadian, but it's really available to anyone outside of UK or the US. So anybody listening from any place else can.
Even in the UK and the US, we can sell to accredited investors, and we comply with exemption or from prospectus requirements. So
got it.
We've done that on a case by case. So the main issue there is we don't have any prohibitions in the fund in terms of the percentage of non-resident unit holders. All the other Canadian funds, if you were to go over 49% non-resident, you would lose your Canadian RSP status.
Uh-huh.
So that doesn't apply in our case. So it's just a question of securities regulations in the country of residency of the investor.
Got it. Got it. Well, and for everybody interested in learning more about the fund, the link will be posted with this podcast page, and you can go there and check it out. And I would certainly encourage you to do just that. Nick is also an author, and he wrote, gosh, when did you write the book? The book is called $10,000 Gold and Why Gold's Inevitable Rise is the Investor's Safe Haven. When did you write that book, Nick?
Well, it was perfect market timing. When the book hit the market, it was when the gold price tanked.
I know the feeling.
So it wasn't great, but the book was in the writing planning stages for years in advance. So
right.
It was something we didn't have control of in the final instance. But in the book, I've concentrated on the long-term trends. And as a result, everything is totally applicable. It's not become obsolete in any way. In fact, the macro trends that I talk about are all firmly in place, and if anything, have increased. Like they've gotten better from a goal perspective.
They certainly have. Just this morning, as we're recording on Thursday, as we got the announcement now that with the Fed having halted at least their overt QE last year, now that not only has the Bank of Japan picked up the mantle, so has the ECB. What do you think about that?
Well, this is, in terms of the Western countries, this is a race to the bottom of who can devalue their currencies the most and fastest. And as one country devalues, ultimately, leads to other countries devaluing, and it goes down. But it should be becoming obvious to everyone that central bank intervention isn't working, and hasn't worked in Japan. It isn't working here, other than the stock market going into irrational exuberance and getting overvalued.
Yep.
But in terms of fundamental reason, it simply isn't working, and the debt is piling up and piling up. And that's one of the main themes when people ask me, well, where did you dream up this number, $10,000? It's very simple. You have about a 97% correlation between U.S. debt and the price of gold, and it diverged for, in my view, obvious manipulation.
Yep.
But it diverged for a point. But if you continue that correlation on up, in plus or minus 5 years from now, you get 10,000. And if the U.S. debt keeps accelerating, and there's no indication that it won't continue to do so, then you get to that number. So this isn't a number I just pulled out of the hat. Yeah, you can come up with 10,000 any number of ways. Gold coverage ratio, the correlation, the cost of producing it, et cetera, et cetera. So it's a quantifiable number, and you can actually get much higher numbers than 10,000.
Well, that actually was going to be my other question about the book, is because I get asked that quite a bit too. I mean, what is if you want to call it fair value or an appropriate price or whatever it is, once all of the shenanigans end for gold, and I always have a hard time answering that because we don't really know what the denominator is. We don't know how much gold there really is because it's been levered.
Well, there's two critical points there, and you're absolutely right about the denominator. See, when you look at investment performance, you have a numerator and a denominator. People tend to focus on the numerator only. Right now, the problems are going to be in the denominator, the currency or gold. So the issue is, if you want to understand gold, you have to look at the purchasing power of gold over long terms, not get deflected in terms of the paper fiat value of anything. So, for example, if you take a in the book, I've got a little chart there. So if you've got a compact car in 1971, when the U.S. came off the gold backing, a compact car was 66 ounces of gold. When the book came out, it was 10 ounces of gold. An average Canadian house was 700 ounces of gold. Today it's 228 ounces of gold. And the Dow was 25 ounces of gold, and today it was 8 ounces of gold. So that's what gives you a totally different picture by changing the denominator to real money versus an IOU currency.
Right. And that's
if you think in those terms, would I look at it and say, if I take my gold out of the vault, convert it into cash, and invest it in something, because as far as I'm concerned, gold isn't an investment. It's money sitting in the vault.
Mm-hmm.
Okay? And when it's sitting in the vault, you're not going to get dividends and you're not going to get interest, but it's also not going to be at risk. It's going to be there day in and day out. So when I invest it, I look at it and say, am I going to get more ounces back at the end of the day than I put in? I don't care what the fiat price is.
Mm-hmm. And that's what, again, in the end, that's what we'll see where we go. I think we all agree, though,
Exactly.
that $1,300 American dollars for an ounce of gold is a pretty good deal at this point.
Well, absolutely. It's slightly above mine production, and there's numerous articles about the fact that we'll likely peak in terms of peak gold in 2015. And mine production is declining, and the ounces per ton are declining.
Yep.
So that's not going to solve anything. It's only going to get much worse.
Yes, and
so the issue is that we're not going to go down in price for any length of time, but the manipulation in terms of almost desperation at this point in time should be obvious to anyone that cares to look.
And I'll ask you.
Conspiracy theory before, it's now obvious and admitted to.
Folks already know my opinion of all of that, but if you don't mind laying out your opinion of why, even today. I mean, we're seeing what should be extremely bullish paper gold news, the ECBQE, but we can't have a runaway gold price, as that would be a lack of, a vote of no confidence of what the ECB is doing. What is your general feeling? Why is there such an active, desperate attempt to suppress price at this time?
Well, it's primarily due to the U.S. dollar being the reserve currency, so you can't have a loss of confidence in the reserve currency. Throughout all of history, there hasn't ever been a single fiat currency that didn't end in hyperinflation and complete collapse. There's not one example of this ever working. Now, what we have is a single fiat reserve currency. So when that goes into hyperinflation and complete collapse, we're going to have a problem. And this is what's happened throughout all of history. This is not some new theory.
Right.
This is fact in the past. So at this point, the U.S. has what has been called exorbitant privilege in having the world's reserve currency, because everybody else has to work for a living and they can just print more currency and buy stuff. So the desperation to hold on. Right now, there's lots of talk about replacing the U.S. dollar with IMF SDRs, which would include a basket of currency, valued proportionally per each country. But that can't be implemented until China gets up to a certain level of gold. Let's call it, for ease of arithmetic, 6% in terms of their reserves. So right now, they can't and won't get China's vote until China gets up there. So part of the reason is also a coordinated suppression to keep the gold price down so China can buy enough gold to get up to the right ratio.
That sounds a lot like what Jim Rickards has been saying, and certainly makes sense.
Well, it's also described, Jim describes it, but it also is described in great deal in a book called The Big Reset. And that's the stated agenda. That's not a conspiracy theory or speculation. That's the agenda. And I'd encourage people to read both books to understand, because this isn't going to be a stair step up in gold. We'll wake up one morning and it'll be 5,000 an ounce. And if you don't own it, you don't own it. You're now going to pay 5,000.
There are a lot of folks think that they'll just wait and they'll buy it then. There won't be any around when that happens. And I assume
that's right. It'll be difficult, and you'll always be able to buy the odd coin and pay a premium and so on and so forth. But if you're wealthy, or if you're a pension fund or an institution or anything like that, when you need to buy billions of dollars worth of bullion, that'll be a problem. You need to, even right now, if you were to buy large quantities, you've got to do it daily and slowly build up. You can't just simply write a check for $5 billion and buy bullion.
Exactly. And when you mention The Big Reset, I assume that's Will Middlecup's book that you're talking about?
That's right.
Yeah. For folks that are listening, they may recall we had Will in here for an A2A 3-4 months ago. It is an excellent book, and I would encourage everybody, if you haven't bought it, to buy that one as well. Just like you should buy Nick's book. I'll even bury a link back to that podcast in this podcast page, so you can go back and listen to that one next as a recap. Nick, I want to move on. We got some questions stacking up in queue. And so I think I better move on to this listener questions here before time gets away from us. And again, for anybody listening, if you'd like to ask a question of Nick, just put it into the dialog box in your GoToWebinar control panel. The first one comes from Angela, who wants to point out that she thinks you're a great guest, by the way, Nick. I'm very glad.
Thank you. I like Angela.
Angela wants to know, what has Nick seen as far as changes in demand, even just awareness for his business in particular and for metals more generally? I guess we'll just say, what have you seen recently as for changes in demand? Are you seeing that pick up?
Well, it's slightly picking up, but generally what overwhelms the price of gold is the paper gold. So we've got good demand in physical, as we can see in the coin sales from the Canadian Mint, the U.S. Mint, the Perth Mint, or record sales in terms of physical coins, record sales in terms of bullion by the central banks. Mm-hmm. But in terms of the general investing public, the sentiment is lower than when I started this in 1998.
Wow. I should tell everybody about all they need to know as well. We've talked a lot about that here, that the key to and what has really driven the suppression, at least through all of 2014, is this idea that the vaults of London are empty, and that should Western investment demand return, from where would the gold come? That is Angela's follow-up question. She's just curious for your company and your funds where you source your gold primarily.
Well, the biggest bank in terms of gold sales in Canada is Scotia.
Right.
And the bullion banks source the gold directly from the mining companies and from other LBMA members. so if there's any source of gold, it kind of goes through that.
Mm-hmm.
Physical gold isn't purchased by taking delivery of futures contracts on the COMEX.
Right.
That's not how it happens. It's a different market, and it's an under-counter market. The statistics aren't generally available, other than you get the daily turnover that the LBMA publishes, and that's the net difference in purchases and sales. But we don't know how much of that is unallocated gold to allocated, because just like us, if you're accumulating gold consistently and buying it all the time, you need an unallocated account as well as allocated storage. It's kind of a two-step process in order to expedite it, because in the unallocated account, I can get confirmations in a matter of minutes.
Sure.
And then you get into physical, you've got to handle it and so on. That comes later.
So when you get orders
within a day or two.
So when you get orders for your fund and you seek out new gold, new silver, new platinum, are you mainly using a Canadian bullion bank like the Scotia, or?
That's right.
Yeah. Okay. I guess that.
So today we haven't had an issue, and you would only get issues if you went into very large numbers. So if you have very large numbers, it needs to be done methodically, and it needs to start right away on a daily basis, and you keep accumulating. Otherwise, you're going to cause the price to go up, and you'll be paying more and more every day.
Sure. A next question comes from a guy by the name of Peter. It's a longer question, but it's got some compliments buried in it, so I'm going to read the whole thing to you. Okay. Peter says he was introduced to BMG by Rob Kirby, who is a fellow Torontoan. I'm sure you know Rob, right?
Yes, I do. We have lunch every once in a while.
There you go. And Peter says he's very happy to say that the majority of his physical silver is with you at BMG.
Right.
When buying 1,000-ounce bars of silver, your premiums are tiny, and he likes that. So one of the things that all of us in the gold community, have been waiting for is for the West to start to run out of physical gold and silver. So Peter wants to know, have you seen any signs of this yet? At any point in time, have you seen limitations to the size of the bullion purchases that you can do, or signals that large premiums are being required for large purchases?
No, that hasn't happened at all. We haven't had any issues over the years in this. The only thing that happens is that if you're purchasing platinum, and Scotia tends not to have a lot of platinum in stock, so to speak, so it has to get imported from either South Africa or Russia, and that may take a week or so to get the platinum in.
Okay. But in terms of...
Now, the other thing we've done is we now offer in our bullion bars program, in addition to 1,000-ounce silver bars, we offer the monster boxes of 500 coins.
Okay.
From the Canadian Mint, and we've developed a method where they can be tracked and serial numbered and secured, because the issue there, as everybody knows, coins don't have serial numbers. So in order to do allocated storage, you have to identify what it is you're storing. So you first have to, and this is what many people don't understand, is step number one is you have to buy the bullion and get clear title to the bullion in your name first. And it's no different than buying a house, a car, or whatever. So in the case of bullion, you need to identify it by refiner, serial number, exact weight, and exact purity. So your title documentation has to include that. Once you own the bullion, then you decide whether you want to bury it in the backyard, take it home, put it in allocated storage. So when you put it in allocated storage, this isn't like putting money in the bank, which is a loan to the bank. This is a custodial relationship where whether it's the bank or Brinks, it's your bullion and they're holding it on your behalf and charging you fees.
Mm-hmm.
So now you can buy coins. Now coins have a premium, obviously, against the 1,000-ounce silver bars, but at the same time, when we look over the past and even when the price of bullion went down, the premium on coins skyrocketed. In the future, when the price of bullion goes up, the premiums will also increase.
Mm-hmm.
So depending on how wealthy you are and how many dollars you are, some of the things you would consider would be having a stock of coins, because you can liquidate them one coin at a time. And a lot of people think they're going to use bullion to go grocery shopping when things get really bad, but if bullion is $10,000 an ounce and you have an ounce of gold, it's going to be hard to go grocery shopping.
That's a lot of bread and milk. Well, you like to think it would be.
You can buy the entire supermarket.
Yeah, maybe. But so far, at least, it hasn't been your experience that you're having any difficulty or seeing any delays in taking delivery of size.
No, none whatsoever.
And that's kind of a follow-up question from a guy by the name of Johnny. Just once, when you mentioned a large quantity, buying physical gold in a large quantity where it becomes an issue. What is a large quantity, do you think? I mean, at what point is it, you got to move it and store it and all that kind of stuff?
Well, in terms of storing at home, you don't have insurance, and you have to make sure you absolutely do not talk about you having bullion at home.
Yeah.
And my kind of number, I wouldn't go over 10,000, 20,000. Again, depends on how rich you are.
Right.
But clearly, if you want to do 10 million, it's insane to store it at home, and you've got to be careful what kind of vault you store it at. People shop around to get a deal on a price, and they don't realize, if you're dealing with a private vault and you don't have the financial statements and you don't know who owns the real estate and you don't know whether there's a mortgage on the real estate, even allocated gold can be lost during a bankruptcy or receivership.
Jeez Louise, you're right.
Okay. If you default on the rent payment, the landlord takes the bullion, puts a little ad in the paper, and you don't see the ad because it's some little town. And under bankruptcy law and under landlord-tenant law in most places, they get to keep it if you don't show up with proof that you own it. So it's a lot more than just allocated storage, and this is not where you negotiate the lowest price. You need to negotiate the most secure deal where nothing can go wrong. Mm-hmm. It's your asset of last resort. This is not where you get cheap prices.
It's an excellent point. And, I think a lot of people, a lot of people listening had never really, I got to tell you, I'd never really thought about that you'd use some storage facility or some storage company and something happens to them, it could really put you in a bind. And I think that makes...
Well, particularly if you're at a distance, you'll never see the ad in the paper that
exactly
announces the bankruptcy and gives you 10 days to prove your ownership and get your assets out of their facility.
Right. Well, now, Nick, you're being very generous with your time. I've got a follow-up from Johnny, but anybody else that has a question they'd like to submit quickly, please put it in. as we begin to wrap things up. Johnny wanted just to kind of follow up because I think I misspoke as I read off his question. He says, "No, what I mean is, does the quantity, what large quantity moves the market in terms of price? As you said before, at what quantity is it a problem for the fund to get the metal, or have you had that issue yet?"
Well, again, obviously it depends on time and so on, but like at this point in time with kind of low sentiment, fairly low demand, you can do 100 million in physical without moving the markets.
In gold, silver, or both, or
either one.
Okay, gotcha.
So platinum might be a little bit less.
Right.
Even at 100 million, at some days you might want to spread it out over a few days.
Okay. Lastly, Russell just put in something. Just wants to know your opinion on the currency wars in general. You mentioned Jim Rickards' book, so I assume this is something that you probably follow. The Swiss National Bank, after fighting the Swiss Gold Initiative, then turned around and dropped their peg, as you know, about a week or so ago. What do you make of that and the ongoing currency wars in Europe?
Well, this is kind of one of the stages in fiat currency. So we're at the stage where it's a race to the bottom, and justified on export competitiveness, but it isn't doing anything in terms of the general economy and isn't, improving GDP. When you dissect the GDP numbers, where, they've been negative for years in real terms and real allocation. John Williams, does an excellent job of that, and John's numbers are, closer to reality than the propaganda you get in the mainstream media.
And no, and I understand where you're coming from, and I guess we'll see what happens next. It is a race to the bottom, though. It certainly seems that way, and it seems like the unity of the central banks is beginning to fracture as well. Central banks working in unison, kind of all rowing in the same direction. It almost seems as if the Swiss National Bank, move was kind of the first every man for himself, looking out for number one type move that we've seen.
Well, there's obviously variations on conspiracy theories and the real agenda and so on and so forth, but the issue is that the bottom line on central banks is they're owned by the banks, and their first priority and everything is to protect the banks, not to worry about what their actions do to the public at large.
Right. Hey, lastly, one follow-up from Peter, talking about kind of theories and trying to assess what's going on behind the scenes. But you've you're where the rubber meets the road with your management company and your funds. And so Peter wants to know, since you've not yet seen any shortages or premiums, what do you think of this idea that the West is, we'll call it, running out of gold, and that it's so much of it is being shipped east? This idea that the vaults of London are empty or running low, that they're scraping the back of the vaults for dust-covered bars from the 60s to send to Switzerland and get them recast to ship to China. What do you make of all that, since you haven't yet seen shortages or premiums in what you do?
Well, I think that, and then one of them, there's a couple of considerations there. One is people don't tie together the COMEX paper trades and the GLD ETF, because most people don't understand the mechanism of the ETF. They think it's just like an open-end mutual fund trust with low management fees. Is nothing remotely close to that. So what happens is that if I short the COMEX with a naked short and the price goes down, the GLD experiences redemptions. The authorized participants are the only ones, and they accumulate GLD shares, and they redeem the physical bullion out of the GLD. And either it's returned to the central bank from where it was borrowed, or it is shipped to Switzerland and then off to China. So you have to understand that mechanism, and very few people do.
Mm-hmm.
And in order to understand that, you have to very carefully read the materials of the ETF, and you have to read the authorized participant agreements, which aren't even on Edgar anymore. Okay? So that's one thing. The second thing is that China has clearly been accumulating, and they officially say they've got 1,600 tons, and they're probably anywhere from 4,000 to 6,000 tons.
Right.
So the mathematicians among us can then go to the traditional mainstream supply demand statistics and say, well, where did that extra 3,000 tons come from? Right? Because the supply demand statistics have everything accounted for.
Sure.
So the issue is with what isn't in the supply demand statistics is the leased gold. So to be perfectly accurate, you have to take the amount of outstanding leases on January 1st. During the year, you have additional leases, some of which have been paid back, and then at the end of the year, you have another net lease number.
Mm-hmm.
If the difference is positive, that's how much gold went into the market from the leasing. The only adjusting entry that you can make on that in the categories is either add it to central bank holdings or add it to investment demand, because those are least accurate, particularly in the case of China. So if you then try and extrapolate where that gold is coming from, you have an anomaly that doesn't add up in terms of the U.S. Geological Survey, which publishes how much of the metals is mined and exported and so on.
Right.
And you'll find the U.S. is exporting significant amounts of, forget what the latest number, but sometimes it was like 700 tons more than they mine. So the only place number like 700 tons can come from is above ground holdings, and out of the above ground holdings, it can only be central banks. So when China announces that they have 5,000 or 6,000 tons, people can do the math and then figure out where that came from, which is above ground central bank holdings, and that confirms what was speculated for years, that half of the central bank is simply IOUs. Right.
That'll be the end at that point, the official end, if not before, of the current gold pool, if you will. If the London gold pool ended in 1968, I would say that would be the end of the current one.
And that's where it becomes critically important, because that kind of an announcement is going to come as a surprise, and when it becomes totally obvious that the gold price has gone up and so on, that's when you won't be able to buy it.
Exactly.
So you need to educate yourself as quickly as you can and form your own conclusions, and you need to be buying now while you still can.
Exactly. And your company is great to do that. And of course, anybody that hasn't yet read Nick's book, $10,000 Gold, While Gold's Inevitable Rise, is the Investor's Safe Haven. A link to
right. And for your clients, if they like to call us and speak to Chloe, we'll give them a special price for the book.
Hey,
directly from us.
Hey, fair enough. I'll make sure that phone number is listed on this podcast page so they can do it. I was going to say there's a link to Amazon, you can buy it, but I think a better deal, a more fun deal, would be to call up your company. Nick, I want to thank you for all your time. Gosh, you've been extraordinarily generous, and it's just been really informative and very, very helpful. Before I let you go, though, we have a tradition around here, what I call the Final Four, which is just kind of 4 quick questions, kind of fun. You can usually answer them in a word, a sentence, just fun, quick questions. So if you're ready,
I have trouble answering questions with one word. It should be much longer.
I know the feeling. All right. The first one is it's January, and you're located outside of Toronto. How much snow is on the ground up there right now?
Well, we don't have too much right where we are. It's only about 3 inches. Further north, there's about a foot. So.
Aha. So it is the Great White North, though, to that extent.
Yeah.
All right. Your company is based in Markham, if I understand that right, which is right outside of Toronto.
Yeah, it's just on the north side of the city, and our offices overlook Buttonville Airport, so the really rich people can fly in their own private jet.
I'll get my
walk over.
I'm going to go pick up my G4 today and whisk up there. But I guess the question is this finally going to be the year for the Maple Leafs?
I'm too busy reading about gold, so I don't follow that. So let's, for all the fans, let's hope so.
No opinion officially. All right, fair enough. Now this one is more for me. But you wrote this book, like you said, it's a process. What is the hardest part about writing a book?
Well, everything you do, it turns out being harder than what you thought. So it took longer. The editing, you're writing a book and things are in a state of flux. So
yeah. Mm-hmm.
That's kind of tricky to do without doing a sequel book, because I get a lot of questions. Well, Nick, do you still think gold's going to be $10,000 an ounce? So I better write a sequel.
So when
that should be out in the spring.
In the spring, like in a couple of months?
Yeah.
Of course, spring in Toronto is like July, I think, is it not? So I got to make sure I'm a little clear about that. Okay, and finally, I guess this is kind of the standard question I always end with. You and I are hanging out in a pub there in Toronto, sharing some adult beverage, and I hand you 1,300 American dollars, and you have the option of buying yourself 1 ounce of gold or 70 ounces of silver. What are you going to do with that money?
Well, if it's only 1,300, I would do silver. Both silver and platinum, my view, will outperform gold in the long term, but gold will be the primary driving factor.
Okay.
But for a variety, each one is a long discussion as to why it would outperform. But I think both silver and platinum will outperform. That's why I set up the first fund that has all three, so you got kind of instant diversification in all three metals, and the fund has outperformed the purely gold fund.
Sounds good to me. And yeah, I think that's tremendous the way that you run it. You just have flat exposure to all three and incrementally just buying more as money comes in.
Right. That's right.
Well, Nick, thank you. Again, I want to ask everybody to check out Bullion Management Group. Excuse me. Check out the funds that Nick runs. Check out the Bullion Bar Storage Program, too. And finally, the book, $10,000 Gold, While Gold's Inevitable Rise is the Investor's Safe Haven. Nick, thank you so much for your time. We really appreciate it. And perhaps we can do this again as the new book comes out and get it rolled out and let everybody know about it in the springtime.
Absolutely. Look forward to it, and thanks for inviting me on your show.
You got it, Nick. Have a great rest of your day.